All right, let me see. I can share this screen too. All right, that just make it a little bit cleaner. All right, so I don't have a slide deck today, but welcome back everybody. Today is it's the first session that we're going to do in September. We're thinking about largely about some of the slides that we're going to start presenting. So some of those are going to be going over option concepts, right? Some Greeks, and then on a base level, and then kind of scaling that up into strategies, and then the application part, of course, is applying that to the market, and just getting a better general understanding of options and how they can be incredibly useful in your trading. So, um, obviously, I am in representation of Dharma Capital Trading. I am the options strategist, and so that's whenever I'm on, I'll talk a little bit about market structure, but all the sessions in which we've done so far, it's always a top-down approach, and I like to take that approach when it comes to trading, because everything needs to start larger and then go into, okay, what are we going to actually do with all of this information, right? It's great to have information. It's better to know how to use it and apply it, and then. Um, Stephen and I have been having a lot of great conversations in the Discord. If you guys are tuning in from YouTube, make sure that you hop over to the Discord, so that we can conversate in there. I am a lot more active in the Discord, and then we'll go over some of those questions today, Stephen, and because they're perfect and they kind of piggyback off of everything that we're trying to do, but also what we talked about last session, right? And so I guess as we head in, last session was around middle of August. Obviously, August for risk on assets generally, and I say risk on assets, right? All markets are relatively correlated if you look at money as the denominator, right? And fiat currency as the denominator, meaning in order to buy or sell something, you need dollars to enter that market or exit that market, right? Um, and so while there may be a correlation between your S&P 500, your US equities to your crypto, um, we like to keep that in the back of our mind, but not treat it as always true, right? And I mean, there's been tons of examples where the U.S. equity market has crashed and Bitcoin has gone higher. Um, so with that in mind, August is a big what's going to happen month, right? Normally, um, it usually sets up for September, and September seasonally is a tougher month for stocks and crypto. Um, so, with that in mind, oftentimes there is a large narrative that starts to come into play around mid-August, and is kind of fulfilled through September of this seasonality trade, right? And so I guess I'll kind of give a large breakdown of what that means, and then kind of our thinking on a macro level approaching this month, and then we'll dive into some of the data, right? The data here that you're looking at in terms of price map, how that's applicable, and then we will dive into obviously the strategy here as well. So top-down approach, what are we looking at in August, right? So if you look forward, the U.S. and largely the global economy has gone into a rate hiking cycle, right? And that happened obviously after the pandemic. And previous to that, the pandemic created a lot of quantitative easing across the board globally. So all of the larger economies in the world slashed their rates, right? Lending came at enormous levels. And the Federal Reserve basically just flushed the economy with liquidity, right? There was repos overnight, which was incredibly conducive for businesses to tap in and borrow money at incredibly low rates, right? Oftentimes, the global economy has a latency to it. It has a lag process, right? And part of that process is around 18 months from what's largely known of the first onset of a tightening cycle, right? And so around 18 months ago, the the global economy started tightening. The 2021, the economy was a little loose. That's when the Dogecoins of the world were priced over a valuation, a market cap valuation of Ford. And arguably Doge, the fundamental creation of it, was a joke. Um, it traded over the valuation of Ford, right? And so that largely screams of a sentiment where the market is a little bit loose in terms of monetary policy. The banks, the central banks of the world at that time started to raise rates, right? Sorry, the Federal Reserve at that time started to raise rates, right? And so basically we went from, in the US, a rate of 0 to 25 bips all the way to 5% to 5.5, right? And that's where we stand today, and that's where we stood for the last 18 months. What that process does and why that exists is it creates a larger cost to borrow money, right? So when you look at borrowing, I'm sure you've seen your credit card interest rates go up over the last year and a half. The reason for that is the federal funds rate has also increased, right? So for those credit cards to borrow money and lend it to you, their cost has gone up, right? And so they have to pass that cost on to you. Their risk has also gone up, right? Because in a hiking cycle, there is a larger risk of defaults and bankruptcies, and they don't know if they're going to get that cash back, right? And so we are in what is considered to be it was one of the fastest hiking cycles we've ever done in history, and so that's where we've been. And normally, come fall time, seasonally, it's a weaker time for risk assets, right? Why am I talking about all of these things? It all coincides with the middle trade in August, right? Oftentimes, if markets know about something or prior to it happening, they price it in, right? So, for example, we've already priced in the rate cuts that are coming in September. We'll get to that. Um, and the market is forward looking, right? So, with that in mind, the market started to started to get worried about risk and started to get worried about a slower economy about mid-August, right? If you combine that with a seasonally tough time in risk and in stocks, crypto, you really start to have a narrative on the top level to where you can start applying some of the data, some of the analytics, and understanding how to position properly, right? Um, there was a couple of numbers that came out in mid-August that shook the market a bit. The market started to sell a little bit, and then obviously the last week of August, um, we're heading into a U.S. holiday, which is Labor Day. Oftentimes, people step away from the desk, and then they reassess their positions. They reassess everything come September, September being the end of the quarter, and then heading into what is seasonally a good time for risk, right? And that's your holiday season, your Christmas, where the consumer is spending a lot more money. But first, we got to get through September. We got to get through October. And so that's what the market's been focused on, right? And so coming into August, end of August, Aug 30, specifically that expiration and prior to that expiration set up for potential downside events heading into September. Two large events to note in September, obviously NFP, which we just had. So three large events, sorry, NFP being non-farm payrolls, the first Friday of every month last week. And then we have a large debate in the US primary election tonight. It is the first time with the new Democratic representative. To see how things to see if there's going to be a shift, right? The Republicans largely benefited from the first debate, and we saw inflows across global market, more of the Trump trade back. And now we'll see if that's going to get reverted. Trump still leads based on some of the betting markets, but we'll see. Tonight's going to be a big debate for the Democratic Party. So that's a large event. And then next, the largest event, obviously, of the month is going to be your FOMC. That's going to be September 17th and the 18th. It is widely speculated that the Federal Reserve is going to slash rates for the first time in this hiking cycle. Uh, they've noted that they're going to do 25 bips. The market's already pricing in possibilities of 50 bips. Every time we get a bad economic reading, the market screams for a 50 bips emergency cut. Likely it will stay in line with that 25 bips and the market will have to readjust. So as we look forward, those are two large events that are happening. And what's played out so far? Played out so far is we have had weakening, seasonal weakening, right, in the markets in September. It started at the end of August, and that would make sense because the market usually front runs risk. Now that the market has been talking about risk, and the trade seems to be everybody is talking about the short side, it's not a coincidence that we have traded the opposite and basically reverted last Friday's non-farm payrolls declines in Bitcoin um, as well as in Ethereum. And so we'll get into the price. We'll get into kind of what's in front of us and the facts that are in front of us. But largely, those are the big events that everybody's kind of looking at in markets. Those are everything that we've been watching since we've last hopped on, right? Um, so, two things to take note, I guess, as we look at these two larger events. Obviously, tonight, if in the U.S. primary debate, there is a positive crypto tone, or the crypto industry largely is talked about in a positive tone, that likely has positive impacts to the market. Inversely, if there's any question about the crypto industry or further regulation, that likely impacts the market in a negative way. Um, and then the FOMC, as it's widely known, it's already priced in that 25 bips is the number. If 50 bips is the number, there likely is going to be some adjustment that probably, depending on the narrative, if the narrative is the economy is weakening faster than what we had thought, that could have a negative impact. So it really is a fine line on how the Fed basically talks about that narrative. So all eyes will be on that after all eyes are on this. So let's hop over to price map. We have Bookmap up here as well. So price map is our proprietary data. Here, I'll keep that up here. So we have some levels of what's going on right now in Bookmap. But price map is our proprietary data. As we look at September, this is our monthly chart all the way over on the left. I want to make sure that we can see that. Yeah, all the way over on the left. Basically, we have traded under the monthly directional. That is seen to be negative under this PMC level, which is the previous month's close. Fundamentally, if the market's trading under the previous monthly close, that is negative. And if the market's trading under this PMM, which is your previous month's mid, it's also seen to be negative. One thing that is positive is basis our monthly. We have traded under the DP right here, this 53,605. We traded into this black zone here and then reverted that trade. The expectation is based on this is what's considered to be a buy DP reversal. The expectation is we will come test this previous month's close level after we do some basing here on the previous month's, or sorry, the monthly CR minus. That will be invalidated with a trade back under the 56,000 level under this, what we consider to be the variance level for that level, or yeah, for that quantitative level, right? So expectation in the short term through the discovery period, right? Discovery period is going to be over the next 4 days into the 14th. This could potentially even cover or carry over into early part of the validation period, which is going to be the next week. So the next 2 weeks basically is a retest of this previous month's close. We will stop thinking that way if at any point in time we see trade under 56, and that's where we will get more defensive and get a little bit more concerned about the market's vulnerability and where will it go. it'll test this 56 or 53,605 level. If it really breaks down under that 53,605 level, our expectation is a test of the previous month's low point, which is around 49. But more importantly, our first stop would be 47,119. So obviously these are all on a monthly basis. So these are numbers that we're watching monthly. They have a little bit more time to play out on a weekly basis. With our trade currently holding this 56,734. Expectation is we retest those highs that we traded yesterday. If we break out of this level, this is what's considered to be a UP breakout. It's a breakout of what we consider to be our critical range. Critical range is the UP down to the DP. If that trades over this level here, so I'll shrink this a little bit so that we can see over that 59,000, our expectation is we're going to come up and test this 62,000 level, which would align pretty closely with our monthly expectation of a full rotation here over the monthly directional into that 63 level. 62, 63, we're expecting, at least in the short term, for that to be a selling level or a level of resistance. So that is Bitcoin. Let's hop over to Ethereum. Just make sure that we cover our basis because we haven't been on in a while. So basically, if we're looking at Ethereum, same kind of trade that's going on here. Let me see. Yeah, making sure that we're still sharing. Okay. Same trade here. Ethereum honestly has been trading a little bit worse than Bitcoin on a structural level. So it's been underperforming Bitcoin, and it has been honestly throughout August. Bitcoin is usually quick to correct back. Ethereum takes a little bit more time. So that narrative still holds true. So if we were to look at price map here, what are we looking at? Same trade, NFP. To fully trade out of that NFP range, we're going to have to reobtain this monthly CR minus level, which is at 24.23. We almost made a buy DP reversal. Basically, is a buy DP reversal. Structurally, this is positive, right? After a try on the breakout of the critical range lows, we hold, we reverse over the figure, and then we trade into this black zone here. Expectation is we're going to hold this, and we're going to trade higher. Where are we going to go? 24.23 is the first stop, right? Where would that be invalidated and where we would be concerned of a retest of this monthly DP? We got to lean on our weekly structure. If we see a trade tonight under 23.17, that would be a trade of concern, right? And more specifically, under this previous week's close, you'll see that aligns perfectly with some retesting over the week. But if we really see a breakdown tonight off the debate of a trade under 22.80, there would be reason to be concerned that this positive structure is not going to extend higher to test this monthly directional, but in turn will likely test the 22.06, the monthly DP. If it struggles there, where's it going to go? 1793 is our figure that we're looking at, right? Those are, again, large swings, shorter term time frame over the next few days to end the week. Positives, any trade that's held over 23.17 is positive. So if you're looking to be a buyer of the market, where do you want to buy it? 23.17. Where do you want to sell it if you're at risk? That 22.80. And the expectation is the market should just scale, right? It should hold this positive structure throughout the duration of this week. If it can't, right, then the expectation is a trade lower, right? Obviously. So that is kind of the outlook, top down, bottom. Yeah, so that's from everything from macro, kind of what's going on in the economy, what's going on in the globe over the last few months, right, since we hopped back on, but also what's going on in our data, right? What are we looking at here in the now? It's great to think conceptually. It's great to philosophize over what could happen, but we have to get granular. We have to take a stance. That's what we do as traders, right? So The next fun part is let's go into some of those questions, Stephen, that you had last week, talking about risk reversals. Risk reversals are great strategies as we approach these markets for a lot of different reasons. And so I'm going to pull those up on the side here just to make sure I answer all of those for you. Um, yeah, just to make sure that I answer all of those for you. So in here, what is a or risk reversal? So let's largely talk about that. I have this screen here too, and then we are trading on the side, so there will be updates if you see those. But I'm here with you today, so I'm not on the desk for this moment. So what is a bear risk reversal? So a bear risk reversal basically is selling a call and buying a put. Why is it considered to be a bear risk reversal? The reason for that is you're selling upside optionality and you are buying downside protection, right? You're buying a put. So oftentimes, traders use this as a very strategic approach to markets to adjust their risk profile. And then within that, it gives a defined risk structure that you can work a range around, right? And so what would that range be for us? Currently, we're trading around 35.55 or 23.55, sorry. Our expectation is our critical range here is 2,500 to around 2,100 because there's less days in the expiration, right? The 13th. A lot of that premium is going to get sold off, but we'll see what we can put on and look at. So we would be concerned of a trade under that 2,100 level. And so let's start there. So what is that premium? So you can run over here to your weekly expiration, right? And you can see that that 2,100 level for those weeklies are going to be around $5. Oh, sorry, 20. That's the 2,300 level. Yeah, 2,300 level. Those are going to be $33. What upside are you willing to give up, right? So $23 or $33 is what you're willing to pay. So let's go put that on here as a trade. And we'll come over here to the position. So 13. We'll come out here and let's say you want to buy 10 of them, right? You'll notice that this this red line is at expiry, as we talk about each week. The green line is your P&L here and now today. The reason it's not just that hockey stick that most people are used to looking at is because there's still extrinsic value on these options, right? There's still 3 days till expiration for one. So there's time value in those options. There's vol in those options, right? Um, and both of those components in themselves will add up to a little bit more value than in a few days from now, right? And we can mimic that by adding a few days, right? You'll notice in 3 days, it does mimic that hockey stick payout. But as of today, that's what your P&L is going to run on, is that green line. Okay, so we bought those and we want to sell. Where do we want to sell, right? Well, if our expectation is for a little bit of a trade higher, um, maybe we want to give it some room here, and we're looking to trade out of these at, let's see, I can scroll this in real quick. So this upper level here we can use, or we can just use this level here. So we'll put, let's say, because there's 3 days left in the option, there's not a ton of time. We'll put something on for the monthly too and just take a look at that just to make sure. Bitcoin obviously might be a little bit easier based on how it's trading to put a risk reversal on, but let's take a look at the weeklies first. So the expectation for this minor level of the critical range is here. We're concerned about a trade under that 2,300 level, more specifically 2,280. And then we want to partake for a trade up here to the 2414. in the next couple of days, right? We are going to have to give up some upside, but we'll talk about how we can navigate that as well. So come back over here to the SEP 13 expiration, and let's see what we have. Yeah, SEP 13 expiration. We come out here and we sell some of those 2400s. You'll notice that this is basically done at flat money, and flat money in the option space means there's a slight credit here to zero cost, right? So this is largely what the position looks like. You'll see that at expiration, the decline in P&L will start to happen at those sold call levels at 2400, and the incline in that P&L will happen at that bought put level, which is at 2300 level. This is why this is considered to be a bear risk reversal, right? Because you lose money as the market goes higher, and you make money as the market goes lower, right? You can trade these independently as a structure on taking a zero cost approach to shorting the market. Um, or you can pair these off with an underlying asset, right? And that's oftentimes what they're used for, right? And so in this example specifically, we'll notice based on our previous conversations that this has a -7 delta, right? Um, and so what do we have to do? Well, basically this structure in itself with 10 coin or 10 options will hedge up to 7 underlying coin at this level, right? So if you buy the 7, you'll notice that that green P&L largely doesn't shift through this area, right? Which aligns with our risk to the downside. But you'll notice as time goes by, this red P&L is our expectation um, for the payouts, right? So our max loss obviously is at that 2300 level. That's the level in which we're willing to risk. Let's see how that pairs up with some Bookmap too. So there isn't a ton of liquidity down there. My expectation is as we kind of trade closer, there probably would be a lot of resting liquidity. This also is Coinbase. So we could check the dynamic books as well to understand where some of those resting bids would be in. One to note would be around that 2100 level. But that's on kind of a larger time frame, and we'll take a look at those as well. But for here in the now, um, this is a great way of hedging up that risk, right? And so let's play through these scenarios, and I'll make sure that I have the chat up on the side so I can answer some of those questions. Um, but so we have our defined upside area, we have our defined low side area. Our payout without this option looks like this, right? As price goes up, obviously we hold the underlying asset, so we make, this is in coin terms, so we make coin. As the price goes down, we lose, right? And so if we were to just kind of compare at 2300, we would be losing roughly around 16 basis points of ETH with this structure on. Oops, let me toggle those on. Our max loss saves us around 1 basis point of ETH, which is 15 bips of ETH. But it also, if we're concerned about the debate tonight and we're saying, you know what, we want to hedge up for the debate, this is a great structure in doing so. Why? Because without this option on option structure tonight, our P&L expectation would be negative 16 basis points in ETH. Tonight, with the structure on, is that green level, we actually would probably wind up being flat. So we're not partaking in the market, right? Let's say the market explodes higher and trades to that 2400 level. Well, as time decays in these options, you'll notice that that P&L will start to benefit, right? And so it basically gives us time to take a neutral approach to the market. Could you check multi-book, please? Yeah. Yeah, Dan, we can, we'll toggle over there. Yeah, let's do that. Here, let me scan this up real quick. Let's see. Dan, do I don't know if I have multi-book here. Yeah, here. I usually use Coinbase for the most part because that's the US flows. So I'm always interested in where the US money is coming in. Um, yeah, but I mean, let's take a look at that. Let's see what we can see in there as well. Okay. Yeah, let me see. Okay. Bookmap data, right? That's the yeah. Okay, perfect. Yeah, let me do that.
And then tick bookmap
Perfect.
data, and then it should be available as a provider for you.
Awesome. All right. And so if I do that, right?
Um, Sorry, my screen's frozen.
No, you're all right. So if I hop over to connections, I pop over to the Bookmap here.
Yep, and then add it as a new instrument with the bookmap data after local connection.
Okay, and then
Okay,
so
we
if
can
I go
solve that
like
after the
this,
session. We can solve that after the session. Don't worry, Spencer. Cheers for trying, though.
yeah, definitely, for sure. I will. Yeah, absolutely. For the most part, I look at the U.S. money, especially during this session to understand where they're kind of sitting in the book. But absolutely, especially in different sessions, I'm interested as well. But as we're kind of looking at this structure, it gives us a way to partake in a neutral approach to the market. And then as time goes by, we'll benefit, right? So we're basically just giving ourselves some time. And then if the market, let's say the market really makes a move lower today, we actually benefit. If it were to crash tonight, we benefit largely based on how these are positioned because of that bear risk reversal, right? So let me see, Stephen, if that Stephen, let me know if that helped. Um, and then I'm also seeing what else you dropped in here. Let me make sure that we have this up so that we're just watching. Okay, perfect. Yeah, I mean, inversely, let's take a look at a risk reversal, right? Obviously, markets have kind of crashed, so there is a opportunity to really get long the market, right? And what does that look like? It's not a trade in which um, all of these trades obviously are for education, so we're not recommending these trades, but it's largely to take this information, understand the structures, and understand how that's beneficial in all of these tradings strategies, right? And so I guess if we were to toggle over to Bitcoin, Bitcoin has been a little bit more positive. And so let's toggle over to Bitcoin as well. Um, yeah, Bitcoin, even on some of the Coinbase levels, makes a lot more sense for where that resting paper is. Paper being resting cash bids, right? So that 54 is aligning directly with that monthly direct or DP. Um, if we zoom in a little bit at that 55,800 level for that 19 coin just in Coinbase, um, that's right in alignment with a break under this monthly CR minus level. Um, so there's a lot here that we can work off of. So if we were to look at a bull risk reversal, what does that look like? Let's toggle over to Bitcoin here. And we're looking at the monthly structure, so let's align with the monthly expiration. Where are we looking at here? We have a market that's basing over 56,705. Where do we want to partake, right? The expectation is the market is going to, if it trades here, it could trade here. If it should stall here, basis a buy DP reversal. But if it doesn't and the market's strong, then where's it going to go? It's going to go that 63 level. So the levels in which the strikes we want to look at, we can look at the 63 level. we can look at this 53 level as well. Under 53, we don't really want to partake in the market, right? Because that market then is vulnerable. Where's it vulnerable down to? 47. Don't want to be buyers underneath that level, right? So let's pull some of those up, and I want to make sure that we have that on always. So let's see, I can toggle this over a bit. So 63, well, first we got to start with the puts. In a bull risk reversal, we're selling the puts and buying the calls, right? So this is a bit interesting, and we'll talk about a little bit more about delta as if the market were to trade lower, we're gonna have to hedge against that in the form of delta, right? And so, all right, what are these levels in which we're looking to sell? We're looking to sell the 60,000s, or sorry, we're looking to buy basically the 60,000s. If it trades to 64 or 63, that's great. Our expectation is over 60,000, it's going to trade there. If it were to break under these levels, we're not really looking to partake in it, right? So we got to look at the 60,000s and see how much that cost is first. So that's going to be around $1,700. So that's where we can go in and see what we can sell to finance that, right? One thing to note is in order to finance that, we actually have to get a little bit tight in this market. And so 55,000 is that area on which it would be a free trade. Let's take a look at that. But let's also pull up Bookmap as well, right? So we have a little bit of a resting bid there on the Coinbase side. 54, we also have a little bit of a resting bid. And then it's kind of staggered throughout that level, right? Which would be in alignment with the expectation that that monthly DP is a significant level. So if we're buying the 60,000s, we got to sell the 55s. Realistically, in a perfect world, what you want to do is you want to put these on lower. So you would have wanted to put these on when the market's basing in this 53 level, obviously, and we're in hindsight, so we have to work with what we have and then trade against it as risk managers, right? And so let's put those on as such. We'll toggle over here, go to SEP 27s. We'll sell the 55s. And let's say we'll sell 5 of those to finance 5 buys of the 60s, right? And that's at relatively zero cost. You can see the 0.003 Bitcoin as the expiration expectation for that risk reversal. So largely that is at zero cost. The reason this is a bull risk reversal is this structure in itself benefits from a higher market, right? So if the market were to trade higher over that 60,000, target that 63, then we're expected to make coin. Obviously, if we were to trade under that 55,000 level, that's where we are expected to lose coin. Now, how do we trade this inversely with the underlying asset, right? You can put this on as a getting long the market, but you can also put this on as a hedge on a short, right? This has a 3.573 delta, basically, so roughly around 3.6 in delta. We're long the market. Where would we be concerned the market, right? 56,705.5 is a break of the monthly CR minus. There would be reason to start hedging underneath that, right? More specifically under these structural levels here, this double bottom here, if we were to trade under that and target this negative variance level, then the concern would be, okay, if we trade under here, where are we going to test? We're going to test at 55, we're at risk, right? And so above that, you just let the trade work, right? And if we're going to scale, we're going to scale. And if we're not, then we got to hedge up. And how do we do that? Hedging up this trade means because we're long essentially 3.57 coin, we can sell that to the market, right? And something interesting to note is here as I toggle up here, there is resting paper at 60,000, which is kind of that strike in which we're buying. So we'd have to scale through that, test that. The market obviously likes to trade to liquidity zones. So that's also in alignment with our expectation. So it's always powerful looking at the microstructure where that resting paper is in Bookmap and correlating it to your overall thesis on price map as well. So to do this, right, let's say, all right, all of a sudden we're trading under that figure here, 56,000, and we're concerned about a move under 55. Well, how do we do that, right? Knowing that we're coming a little late to the market, we would just sell some coin to the market, right? So pull up our perp platform, and we would sell. If you want to get short the market, we can sell a little bit over the delta, right? And that'll give you a fun little payout like this. That green expiration or that green line is what you're expected to unrealize today and in the moment. So if we were to really trade under, then the expectation is we would be up in this area and then we would start to lose under these areas again. Obviously, because we have a short lean on the market, we would lose if the market were to go higher, right? Same thing here. If we were to just flatten out our risk, so instead of putting on those 4, let's put on 0 just to understand our delta again, 3.57. Stephen, I see your questions as well. We're gonna, those are great. Let's, we'll dive in those in a second. Let me make sure that I put a negative sign here. As I'm somebody that learns from an interactive experience, so questions are always welcome. And if I'm looking at all the questions in the Discord, I am not looking at them on YouTube. So if you have questions, make sure to join us over in the Discord, and we'll get those answered for you during the session. So similarly here, if we were to flatten out our deltas into the debate, right, we can do that, and we have a relatively flat exposure. Something to note is we have 5 options on here, right, from this risk reversal. The delta at this very moment is only negative 3.573. As we trade into these strikes will actually pick up delta. And so they'll start to mimic a higher delta. So you'll notice that we get short a little bit more towards those strikes, and our P&L will start to decline because of that, right? So that's a little bit more complex, but we'll get to that in the future. We've talked briefly about it in terms of delta, but I don't want to dive too far in. Options can be complicated, but they're awesome strategies to use for risk mitigation. So I am going to open it up to questions because today, yeah, I'm going to open it up for questions today. I know we kind of talked about a lot. We talked about macro. We talked about kind of what we're thinking about in terms of the structure that we're presented today from our data analytics. And then we've also touched on some of our Coinbase markets. And then next session, we're going to get into global markets as well. And I want to see that resting paper everywhere as well. So let me see what questions we have in the Discord. So yeah, so when we talk about bull risk reversals and we talk about bear risk reversals, there's oftentimes multiple different names for it. A risk reversal is also called a fence, depending on who you talk to. So basically, the structure in itself in options terms is selling a put to finance a call, or selling a call to finance a put. That's tactically what is being done. Yeah, and so sorry, in terms of the question is, what does the term hedge up mean? Hedge up just is a trader lingo that's used to talk about mitigating your risk, right? So if all of a sudden you have directional risk to the market in the form of delta, or in the form of different Greeks. Hedge up just means to do something inversely to take that off the books, right? So if you own one share of Apple, you own one Bitcoin, and you want to hedge up and you want to neutralize that position, you need to sell that one share of Apple, sell a fractional portion of that Bitcoin or that full Bitcoin to hedge that position. Hedging is a way to take off some of your risk that you already have on. Another question is, why would you want to hedge it? If it trades lower, it is because you're taking on more risk. Hence, the delta figure is important to take note of. Yes. The fun part here is once you learn options Greeks, once you learn portfolio Greeks, you're never going to be able to look at the world the same. You'll look at your balances, your exposure in everything in the world in the terms of Greeks. You also look at them in terms of risk, right? So basically delta is one of the most important figures when looking at a portfolio's risk initially. It has one of the largest impacts on your P&L, and then there's also other components that we are going to get to and talk about that do also impact your P&L. So absolutely delta is the most important to start out with. It's also one that's easier to understand when first entering into the world of portfolio Greeks, right? So yes, basically you can think of delta. If you have a positive delta, your expectation is the market's going to go higher. If you have a negative delta, your expectation is the market's going to go lower. In simple terms, each structure has a different kind of payout and strategy around how to adjust. We went through some strategy today on a relatively basic level, but you can always expand further depending on the trader on what they want to do with that knowledge, right? Yeah, I mean, there's no such thing as a bad question. That's how I've learned everything is through talking with people, reading everything possible. So um, another question is when you mentioned tend to look at more U.S. liquidity, do you find you're more actively trading during RTH than ETH, right? Are there more opportunities during that time or just more reliable setups? It's a great question, right? RTH being regular trading hours, ETH being extended trading hours. Markets are global, right? For the most part, crypto markets in specific are global, right? And understanding where the paper is during the regular session is important because it shows where that U.S. money is. Potentially. Doesn't always mean that's true. As markets kind of have evolved, they're 24/7. And especially in the crypto market, they're 24/7. Most people are going to be trading, and a lot of larger money is going to be allocated electronically. So it's not always fair to assume that a trade that's done during US regular session hours is US money. However, oftentimes there's correlations within trading hours, right? And so, um, purely based on a sleeping schedule, on the discretionary side, most discretionary traders that are in those time zones are going to be making their active decisions during that regular session and through sessions of time in which they're awake, right? Um, so that is specifically why US money during this period of time is interesting. Extended hours absolutely is interesting for different reasons. There is a dead period of time in trade, often in crypto, that's around the Chicago close. That is a little bit less liquid, and it extends into what is considered to be around the Asian Open. And that's going to be your first start of the overnight session. But also what's widely seen as the close of the day in crypto, which is around 0 UTC. So each time zone obviously has their different liquidities that are pushing markets. I think fundamentally, if we were to just simplify markets, what are they? They are machines buying and selling things, entities buying and selling things, people buying and selling things. How are they going to do that? With money. When are they going to do it? Most likely going to do it when they're awake, if they're clicking buttons. And then machines specifically, um, obviously can trade all hours of the day, right? So those are a couple things, and why time zones matter. So that, yeah, that's basically it. That is our first session back in a couple of weeks. I hope everybody had a good end to their August, and then a couple of their first week in September. Markets are likely going to be incredibly active through the end of the year. It's going to set up for a very interesting climate for risk, both on a political front. U.S. primary election likely is going to stir the pot, but also on what likely is going to be a rate cutting period for global economies. And we've started to see that out of central banks globally. We'll get a final confirmation from the U.S. Federal Reserve starting on the FOMC this September, basically in 7 days, 7 to 8 days. And that's going to set up for potentially what is seasonally a positive October. And we'll see if the global economy can can hold through during that period of time. So October October is definitely front and center. I've done actually a lot of research behind that. If you just look at the raw data, it's valid. So we'll see. We'll see. Obviously, just because you have data and seasonality trades play out from time to time, it doesn't mean it has to happen. So, being risk managers at the first and foremost is kind of our job. So, enjoy the week. Ideally, I'll be able to hop back on next week, and we can start in some other Greeks and some other strategies. So. Thanks for hopping on, and I'll see you guys next week.